Hello again. I'm Sue Lloyd, Vice Chair of the ISSB, and I'm back with you to do a deep dive into Chapter 2 of the Materiality Guide. Having spent time talking about the definition of material information, we'll now turn our attention to what it is you're providing material information about. That is, of course, sustainability-related risks and opportunities that could reasonably be expected to affect an entity's prospects. This is Webcast 3 of our 5-part series. We've already gone through the introduction and overview of the Materiality Guide in the first webcast and the definition of material information in the second webcast. Webcasts 4 and 5 are already live, and you can watch them on the IFRS Foundation website. I suggest watching these webcasts in the order that they are shown on this slide. In this webcast, we're going to cover Chapter 2 of the Materiality Guide, which explains both what the ISSB standards mean by sustainability-related risks and opportunities that could reasonably be expected to affect an entity's prospects, and how to identify those sustainability-related risks and opportunities. We refer to this as the what and the how. I'm going to hand over to Dianora, who's going to kick off this portion of the discussion.
Thanks, Sue. Great to kick us off on the deep dive of Chapter 2. I'm Dianora DeMarco, ISSB Technical Fellow leading the S1 and S2 implementation work. I'm joined by David Boulderson, ISSB Technical Director, and we'll take you through this chapter together. So let's start with the what. The ISSB standards do not define sustainability-related risks and opportunities, and this is intentional given the nature of this concept. Instead, ISSB standards describe sustainability-related risks and opportunities and the concepts that underlie this notion. So on the left side of the slide, you'll see these underlying concepts. We're going to talk about each one to build to this explanation of what is meant by sustainability-related risks and opportunities. On the right side of the slide, it explains a little bit about how these concepts come together in S1. That an entity both depends on and affects resources and relationships throughout its value chain, which might give rise to sustainability-related risks and opportunities. So let's talk through these concepts, starting with the value chain. So let's have a look on the left-hand side of the slide. The value chain is defined in part as the full range of interactions, resources, and relationships related to a reporting entity's business model and the external environment in which it operates. This emphasizes that in determining the scope of its value chain, the entity considers both its business model, which are aspects of the entity's operations associated with creating value and generating cash flows, and its external environment, which is really just any external conditions and events that affect the entity's operations. So there's an example in the Materiality Guide that explains this further, and we've summarized it here on the slide. In this example, the entity manufactures electronic devices, and in considering its value chain, it looks at, well, first its business model. And here, the entity depends on third-party vendors to sell its products to customers. So in identifying sustainability-related risks and opportunities and looking at its value chain, it should consider its relationship with these third-party vendors because it's in its value chain. When considering its external environment, this entity identifies a regulation, and the regulation standardizes and limits the types of charging devices permitted to be manufactured by this electronic device company, and that regulation is just in an effort to reduce, let's say, electronic waste. The entity identifies in its external environment this regulation that could affect its operations. So both of these examples showcase how an entity interacts throughout its value chain. And the emphasis here is not necessarily to make a distinction between the business model or versus the external environment, but it's instead to make sure that both are being considered. So for example, to help companies think through, well, what is really meant by external environment? That it isn't just something external to the company, because a third-party vendor is external, but that comes into consideration as part of the entity's business model here. The external environment, more broadly, it's really relating to those external conditions and events, like the regulation in this example, that affects the entity's operations. Let's move to the right side of the slide. IFRS S1 also explains that To identify its sustainability-related risks and opportunities, an entity considers its interactions with stakeholders, society, the economy, and the natural environment throughout its value chain. IFRS S1 explains that an entity's ability to generate cash flows is inextricably linked to these interactions. So said differently, the entity cannot generate cash flows without these interactions. So it must look to these interactions throughout its value chain. But what does that mean? Well, I think that's best explained using an example, which we've summarized from the materiality guide on this slide as well. Dave, will you take us through this one?
Sure. So here, an entity operating in the containers and packaging industry depends on suppliers in 3 jurisdictions. And as Dianora just previewed, it needs to consider its interactions throughout its value chain. So let's consider those in each of the jurisdictions. Jurisdiction A's local communities are protesting against the entity's deforestation practices, which could affect the ability of the entity's suppliers in Jurisdiction A to do business with the entity. So what this does, it reinforces the consideration of interactions with society. Jurisdiction B's government has introduced a tax incentive for entities pursuing sustainability operations, which could influence how the entity's suppliers operate. So this reinforces consideration of interactions with the economy. And then lastly, we have jurisdiction C. It's operating in a jurisdiction which is experiencing a drought, which could affect the ability of the entity's suppliers in jurisdiction C to produce the raw materials needed by the entity. So this reinforces consideration of interactions with the natural environment.
Thanks, Dave. What I like about this example as well is that it reinforces that some of these interactions are direct and others are indirect. And so said differently, it isn't even that the entity itself is interacting in all of these instances. In some cases, it's the value chain entity that's interacting, and that is what is indirectly affecting the entity. And so the entity needs to consider these things. Now, the ISSB was aware of the potential breadth and scope of the value chain, so to be helpful, and as noted at the bottom of the slide, the standards provide a proportionality mechanism to support the application of this requirement. We won't spend time explaining this proportionality mechanism as part of this webcast, but instead we will point you through the webcast series on proportionality mechanisms that is available on the IFRS Foundation website to learn more. Moving on to resources and relationships. To identify sustainability-related risks and opportunities, an entity must also consider the resources and relationships throughout its value chain that it depends on and affects. I think the easiest way to understand resources and relationships is right here in the diagram on the slide. Some forms of resources and relationships are in this blue row here. So you have human, intellectual, financial, and so on. The examples underneath each form bring to life what the resource and relationship might be. So for example, an entity's workforce, you have land, there's a resource, there's a relationship. So when thinking about these resources and relationships, it's important to keep in mind that they can be internal, so the entity's workforce, but also external, such as the materials and services that the entity needs to access. And just one more point on this, resources and relationships include, but are not limited to, the resources and relationships recognized as assets in the entity's financial statements. The third concept is about how an entity directly and indirectly depends on and affects resources and relationships. IFRS S1 explains that an entity depends on resources and relationships to generate cash flows and affects resources and relationships through its activities and outputs. These dependencies and impacts contribute to the preservation, regeneration, and development of resources and relationships, or to their degradation and depletion. There are 2 examples on the slide that illustrate this concept a bit. In the first example, the entity extracts groundwater for irrigation. So this is the activity. The entity depends on water to operate its business model. There's your dependency. But the entity also impacts that resource because the entity's activities might actually deplete the water source because of its dependency on water and its activities impacting the water. So this might be sounding a bit circular, but this will come together in a minute. But maybe just as another example, we have an entity here that invests in employee training. That is the activity. The entity depends on employees because, let's say, a highly specialized workforce is needed to operate its business model. The entity's investment in training can help to develop its workforce because of its dependency on the highly specialized workforce and its activities which impact the workforce. So as illustrated, an entity's activities and outputs can affect resources and relationships on which it depends, which brings us then to the interdependent system. I think Dave, you'll walk us through this one.
So we've explained that an entity's activities and outputs can affect resources and relationships on which it depends. In such circumstances, the entity is affected by its own impact on the resource or relationship. This independent system might give rise to sustainability-related risks and opportunities that could reasonably be expected to affect an entity's prospects. However, an entity's dependencies and impacts might not always be closely related. That is, an entity can depend on something it does not impact, and can impact something it does not depend on. Yet in both cases, the dependency and impact might give rise to sustainability-related risks and opportunities that could reasonably be expected to affect an entity's prospects. The visual on this slide is used throughout the materiality guide to illustrate several examples that expand on these ideas further.
So pulling it all together, IFRS S1 explains that an entity's dependencies and impacts on resources and relationships might give rise to sustainability-related risks and opportunities. We still need to explain what is meant by could reasonably be expected to affect an entity's prospects. So maybe we'll start with could reasonably be expected. This is essentially an assessment of how likely it is that an entity's prospects could be expected to be affected. When considering whether a sustainability-related risk or opportunity could reasonably be expected to affect the entity's prospects, it is possible for a sustainability-related risk or opportunity to be identified as meeting the test, even if the entity itself does not have the expectation that the sustainability-related risk or opportunity could reasonably be expected to affect its prospects. This requires that an entity consider its external perspective as part of this assessment. And for me, I understand this best with an example. So let's walk through the example we have on the right-hand side of the slide. So here we have an entity. The entity is a clothing manufacturer, and it sources its supplies from a jurisdiction that is known for its effective human rights protections. The entity's industry peers have disclosed risks of human rights violations throughout their supply chains and in their sustainability-related financial disclosures. Though these peers source their supplies from jurisdictions which the entity does not. So when the entity is assessing its sustainability-related risks, the entity considers both its own entity-specific factors and external factors. So for example, on one hand, it might determine that the entity itself does not expect the risk of human rights violations throughout its supply chain to affect its own operations. And on the other hand, it might also determine that the industry in which it operates is known to be exposed to risks of human rights violations throughout its supply chain. But due to the entity's concentration of suppliers in a jurisdiction that is known for its effective human rights protections, the entity may not believe itself to be exposed to such a risk. However, the entity might determine that it could still be reasonably expected to be exposed to the risk of human rights violations in its supply chain because of primary users' expectations about this being a risk for an entity that operates in this industry. So in such a circumstance, the entity itself would just disclose the associated material information. Let's now explain an entity's prospects. In ISSB standards, an entity's prospects refer to an entity's cash flows, its access to finance, or cost of capital over the short, medium, or long term. The effects of sustainability-related risks and opportunities on the entity's prospects are set out on the left side of the slide. We want to emphasize a particular point here: access to finance and cost of capital. And what this means is it brings into the assessment how other market participants might interact with the entity. And so you have to think about these things over the short, medium, and long-term time horizons.
Okay, so we've just gone through what all these things mean: value chain, resources and relationship, prospects, and so on. Earlier, we talked about the independent system and how the resources and relationships throughout an entity's value chain on which it depends and which it affects can give rise to sustainability-related risks and opportunities. We also noted that an entity can depend on something it does not impact and can impact something that it does not depend on. This slide visualizes each of these scenarios, including an example of each. Note that the green and blue arrows you see on the diagram represent that an entity can contribute to the preservation, regeneration, development, degradation, or depletion of a resource or relationship. These examples are found in the materiality guide and are helpful in illustrating this concept, so definitely worth a look.
So taking a step back, this whole process that we explained in this webcast should result in a list of sustainability-related risks and opportunities that the entity believes could reasonably be expected to affect its prospects. And that is the set of sustainability-related risks and opportunities that the entity is then required to prepare material information about. So now that we've walked through, well, what do we mean by sustainability-related risks and opportunities, and we now understand what they are, we'll pivot to what the ISSB standards say about how to identify these sustainability-related risks and opportunities. So entities often already have well-established processes for identifying sustainability-related risks and opportunities. So ISSB standards do not require that the entity use any specific approach or method to identify sustainability-related risks and opportunities. So we won't speak to any of those, but instead we will focus on what the standard says about this. So the standards require entities to consider specific sources of guidance, essentially standards and frameworks, to identify such risks and opportunities. We go over the source of guidance requirements in the next webcast related to identifying material information, so we won't spend too long in this webcast given the many similarities between the requirements related to sources of guidance for both identifying your sustainability-related risks and opportunities and identifying material information. But the diagram you see here depicts the hierarchy, if we can call it that, the hierarchy of requirements related to identifying sustainability-related risks and opportunities. And more information is, of course, found in the materiality guide. What I do now want to highlight are a couple of key points on the slide. The first one being the proportionality mechanism that we referred to earlier is also applied to identifying sustainability-related risks and opportunities. So this means that an entity, this proportionality mechanism is actually the requirement to consider to use all reasonable and supportable information that's available to the entity at the reporting date without undue cost or effort. And what this means is that an entity is not required to undertake an exhaustive search for information to identify these sustainability-related risks and opportunities. But instead, it must use all reasonable and supportable information that is available to it at the reporting date, subject to that information being available without undue cost or effort. So a really helpful mechanism for identifying sustainability-related risks and opportunities in S1. The second thing is IFRS S1 also specifies when the entity is required to make this assessment, or really when it's necessary to reconsider assessments, highlighting that when there is a significant event or a significant change in circumstances, entities must reassess sustainability-related risks and opportunities throughout the value chain. Applying these requirements results in the identification of sustainability-related risks and opportunities that could reasonably be expected to affect the entity's prospects. This essentially determines what an entity needs to provide information about when applying the ISSB standards. And this brings us to the end of this webcast series. Tune in for session 4.